Good afternoon. Welcome to the Tarpon Springs Campus 2012 Health Information Sessions. My name is Ron Boyce, and to my left is Tracy Mullen, who is a Senior Account Manager with Aetna. Today, the purpose of today's meeting is to talk to you about the health changes that will occur going forward in 2012, as well as to discuss with you a new type of arrangement called a high-deductible health plan that the college will be piloting in 2012. And when I say piloting, it means that we will also continue to have our current open access plan and our point of service plan, but in addition to those two plans, we will pilot a new high-deductible health plan called the open access plan with an HSA. Well, where are we today? Currently today, St. Petersburg College is a self-funded provider, which essentially means that the college basically incurs all the claims costs. So what happens essentially is that most companies, what they do is they contract out with an insurance company to take care of all the claims, take care of all the claims processing. But what St. Petersburg College has decided to do is that we have decided to contract with Aetna, who is considered our third-party administrator, to handle all our claims processing, where any claims that are incurred, the college pays those costs. So that's essentially what self-funded means, or self-insured. Also, the college provides a wide variety of benefits. We provide medical, dental, and life insurance benefits, and those are all provided through Aetna. We also provide some voluntary benefits as well. We talk about vision, held by assurance, disability, and cancer insurance. We also have a hospital indemnity plan as well as an all-state cancer plan as well. And we also provide a medical expense reimbursement plan. This particular reimbursement plan, we reimburse employees for vision coverage. So for example, employees that have been with the college for 10 years or more, they are given $175 annually for any vision expenses they incur. And for those employees that have been here less than 10 years, they are provided with a reimbursement of $175 every 24 months. Also, the medical expense reimbursement plan covers the cancer and any other dreaded disease coverage up to $1,500 annually. Meanwhile, given these particular plans that we have at the college, costs are rising. Projected claims for 2012 is $15 million. I came back to the HR department back in 2008, and during that time, claims were $9.2 million. As of the end of this fiscal year, claims were $13.6 million. So claims literally rose basically about $4.4 million, roughly about 50%. We're projecting that by 2012, claims will go up even higher. And even though claims have gone up, the college has not passed that cost on to the employees. But times are changing. So, given that fact, what can we do as a college? We can't continue to see these claims rise, not pass that off to the employees. So what can we do? So what the college did is they enlisted Brown & Brown, an insurance company, and a consulting firm as well. And they came in and they looked at our benefits. We essentially paid them $75,000, and in return we got almost a $280,000 return from Brown & Brown. And what they did, they looked at all our benefits, they looked at our vendors, and they compared our vendors with other vendors. And they went out there and they marketed our programs for the college. And they came back and said, okay, Aetna does this well, Advantica does this well, Assurant possibly doesn't do this well, and they did a comparative analysis and came back and said you can save money if you stay with certain vendors or if you drop certain vendors. So as a result of that, these are the things that's changing for 2012. We're keeping Aetna as our health plan administrator. They will continue to process our health claims. They will also continue to process our dental claims. They will also continue to process our life insurance. As you know, the college provides employees with 1 times their salary life insurance. Vision insurance through Advantica Vanica will also be a vendor for the college next year. As far as disability programs, we are switching from Assurant to Lincoln National. They call it Lincoln Financial, but Lincoln Financial Group. Primarily because through this analysis that Brown & Brown had done, we realized that we can reduce the cost to our employees by 40%. You as an employee can save 40% on your short-term and long-term disability program. As well, Lincoln Financial offered weekly payouts for disability. Assurant was unable to do that for us, so as a result of that, that was another reason why we dropped Assurant as well. Plus, Lincoln offered a 3-year guarantee of rates. So the rates you'll see in 2012, you'll have in 2013, and also have in 2014. And there's no pre-existing condition exclusion during open enrollment. So if you got some illness, there's no pre-existing condition, you will not be excluded from getting disability insurance with Lincoln. What else has changed? Well, as I mentioned, as claims are going up, this is the first year in 5 years that the college has decided to pass some of the premium off to the employee. Now, mind you, we did a lot of due diligence on this. We took this to the insurance committee. This went to the Career Service Council, also went to FGO as well. And so these things got vetted through a lot of processes before we came to a conclusion that in January of 2012, we're going to raise your current premium 4%. And I've got some premium sheets that we'll hand out after the presentation. July 1 of 2012, we'll raise that premium another 4%. So in essence, there'll be an 8% premium increase over the course of the year. Still excellent when you look at what companies are doing. They're normally passing on a 10 to 15% premium increase annually. As I mentioned, the college has not increased their premiums in the last 4 years. There'll also be some medical copay changes. What we're trying to do is allow our employees to become educated consumers of their health care. So as a result, emergency rooms today cost $100 to go to the emergency room. It will cost $150 in the new plan. Primarily because what we're seeing is that employers are using the emergency room as a facility to go take care of such things as maybe getting stitches, setting bones or whatever. And we really want to encourage employees to become better consumers of their health costs. So as a result of that, emergency rooms are going up from $100 to $150. Outpatient surgical facilities, that premium will increase, deductible will increase from $50 to $100 as well. But as you do see, walk-in and urgent care clinics will go down from $50 to $30. We want to really encourage our employees to use urgent care clinics for broken bones, sutures, whatever, as opposed to going to the emergency room. Okay? So those are the changes in copays that you'll see for the 2012 year. Also what's changing, there'll be no changes in the copays for dental. Okay? Premiums will stay the same, what they are today. They'll stay the same for 2012. We're dropping the cleanings from 4 to 2. I even used to have problems with my dentist convincing him that we paid for 4 cleanings. He thought we were kind of crazy. But I actually had to take in my plan summary document to prove to him that the college now pays for 4 cleanings. But as of the end of this year, we will no longer pay for 4 cleanings. So I would encourage you to get your cleanings before the end of the year. Okay? Term life insurance. We currently provide 1 times your salary. In 2012, the college is upping that, and we will pay 2 times your salary in term life insurance. And vision insurance, the premium for vision, if you currently have vision insurance with Vanica, they've dropped their premiums roughly 29%. So that decrease will be passed on. Because it's a voluntary benefit, that decrease will be passed on to the employee. What's also changing? We're going to have some different tiers this year. Okay? This year, we have an employee, we have an employee plus 1, and we have a family coverage. Our employee plus 1 coverage covers an employee plus a spouse or employee plus 1 child. As you notice in 2012, we're going to continue with the employee-only coverage. We're going to have an employee plus spouse/domestic partner coverage. And we're going to have an employee plus child/children coverage. Yes, if you could. Domestic coverage, the partner is either same-sex partner or heterosexual partners. So boyfriend and girlfriend, you will have to, there will be some requirements, just like we do with, to verify that you have dependents, like justify you have dependents, you have to justify that your domestic partner is indeed your domestic partner. You've been living together, you got a lease together, you've got insurance together, you're signed up on wills, and this, you have to be living together for a certain period of time. So we're still formulating those requirements. This is something that the board approved. There are many colleges and universities in Florida that are now covering domestic partners, and the board wanted to do this as well. And family coverage will also be family with spouse and domestic partner and their children as well. Now, the employee plus child or children says that if I'm a single father and I got 37 children, they all get covered under employee plus children. The key here, the reason we broke out the two tiers between employee plus child and employee plus spouse is that spouses cost more than children. And you'll notice that the premium for employee plus children will be less than employee plus spouse. Okay, so given all the stuff we're doing in 2012, that's still not enough. As I mentioned earlier, we're going to be piloting what we're calling this high deductible health plan, which essentially means that there's going to be a high deductible, but you're going to have low premiums. And you notice when I pass out the rate sheet that the premiums for this new plan, this open access select plan, will be less than the premiums for our regular open access plan or our points of service plan. But essentially we're talking about a high deductible health plan featuring, like I said, high deductibles, but lower premiums, and it involves employees paying the deductibles and coinsurance amounts, not co-payments. So essentially negotiated rates that have been negotiated with healthcare providers, those are payments that employees will be making. And kind of with that, I'm kind of going to pass the baton off to Tracy because she'll get into detail about our new pilot program. Again, it's a third option. We're not moving away from our current options. It's a third option. We're giving our employees an alternative to our current plans. And Tracy will go into that in detail.
Thanks, Mark.
Okay.
Can I ask a question?
Yes.
This concept of
How are you guys doing today? Can you hear me?
Good, thank you.
Good. Okay, there's going to be a lot of information. I'm going to try to keep it as simple as possible. I know there's a lot of new terms, and we'll go through those, and at the end we'll stop and answer all questions that you have and go back through anything that you have questions. So if you come across a question, jot it down, and then we'll go back, okay? All right. Oops. Okay. Essentially, when you have a high deductible plan, you have this high deductible that you have to meet first. And typically it's $1,000, $2,000, $3,000, whatever the case may be. In order to offset that high deductible, what the government has said is that you can open up a health savings account. And the benefit of a health savings account is that it is a savings account. It is not an insurance product. It allows you to put money into this health savings account on a tax-free basis. It is an account that you own. So if you were to leave the college, you can take the account with you. You can pay your deductibles, your coinsurances with the health savings account. The contributions that you make from your payroll are tax-free. So you're lowering your taxable income and you're putting your money into your health savings account. You're then paying your health care costs with your tax-free dollars out of your health savings account. So that's the benefit of it. You can use money out of your health savings account for your medical services, your dental services, vision services, and your prescription expenses. So it's not just limited to your medical plan. All right? In addition, the funds carry over from year to year. So if you have $3,000 in your health savings account at the end of the year and you've spent your money wisely, that will follow over to the next year, and you can use that money and continue to build on that. All right? An HSA can also be converted once to an annuity, so if you get to retirement age and you have a nice nest egg there, you can then roll it over to an annuity. So some people also use this as another tax shelter savings vehicle. All right? And then I mentioned if you leave the college, you still own the account. How does a high deductible plan work? First of all, you have this deductible phase. So while you're in the deductible phase, you as the employee are going to pay the negotiated cost for any services that you incur until that deductible has been met. So let's say you go to the doctor and your negotiated rate for the specialist visit is $95.92. Instead of paying your copayment, the doctor is going to bill you the Aetna negotiated rate, which is $95.92. You can pay that out of your health savings account. Make sense? Okay. So you're in the deductible phase. You pay all of the negotiated costs. That includes your prescriptions. There are some exceptions to that, but if your prescription, you go and you get the new Nexium or the new thing that's on the commercials, and the cost for a 30-day supplies is $230, the pharmacy is going to ask that you pay $230 until you meet this deductible. All right, there are no co-payments under the high deductible plan. Until the deductible is satisfied, you're paying that Aetna negotiated rate. Once you go through the deductible phase, you've satisfied your deductible, you then hit the coinsurance phase. What that means is that now that you've satisfied your deductible, you go back into that same specialist, and that office visit, let's say, is $100. Our negotiated rate is $100. We're going to pay 80% of that, so we're going to pay $80 of it, and your doctor's going to bill you 20%, or in this scenario, the $20. Everybody with me? Okay. Through the coinsurance phase, there is a maximum, so you don't continue to pay indefinitely. So you do have what we call an out-of-pocket maximum, similar to what you have today, but with just your co-payments. All right?
I have a question. Is that deductible? Is it calculated on a per incident or per visit basis, or is it?
It's on a calendar year basis.
Calendar year?
Yes, correct.
So it's
Okay. Yes, so your deductible will start January. You satisfy it in February, you do not meet the deductible again until the following January. Make sense? Okay. So how much does an employee pay with a high deductible plan? So in this scenario, phase one, if you're an employee only, your deductible is $1,500. If you are a family, and note, if you cover yourself and one other person, you are considered a family. There's not 1 plus 2 or anything. If you're an employee, you're an employee. If you cover one and yourself and one other person, you're considered a family. So as an employee, your deductible would be $1,500. As a family, your whole unit that's covered under your plan would have a $3,000 deductible. So everybody's money would go into that pot. Once you've satisfied that deductible, you then go into the coinsurance phase. Aetna pays 80%, you pay 20%. When your 20% then reaches, as an employee, $1,500, or as a family, $3,000, you have 100% coverage for the rest of the year. So there's a ceiling to your out-of-pocket maximum. Okay? So the total expense that you're going to pay as an employee under the high deductible plan would be $3,000. Remember, you're paying those expenses with your pre-tax dollars through your health savings account. As a family, the out-of-pocket maximum, because the deductible is $3,000, your coinsurance phase is $3,000. The maximum that a family would pay is $6,000 in a calendar year. So again, these are the different phases. St. Pete College understands that this is a lot of money that you're being asked to pay up front until your deductibles have met or your out-of-pockets have been met. And to offset that, St. Pete College is willing to partner with the employees to fund part of your HSA. So St. Pete College is giving you money to put into your account. Okay? Free money. Okay. So if you're on the high deductible plan and you open up a health savings account, St. Pete College will say, because you, as an employee, you have a $3,000 deductible, for the first year that you're enrolled in the health savings account, they're going to give you $1,500 to put into your account. So you start off with $1,500. So in essence, your deductible has been cut in half. As a family, they're going to give you $3,500. So if you're a family unit, they're going to deposit $3,500 into your health savings account day one. Again, the seed contribution is only for the first time you enroll into the health savings account. It's not going to continue next year, so this is the first time you're enrolling, you get the seed money. So let's talk about your current Open Access Aetna Select plan and then the Open Access Aetna Select plan with the HSA. And when I say with the HSA, that's the one that has the high deductible plan. So you have your copay plan and you have your high deductible plan. It's the same network of providers. It's the same negotiated rates with our discounts. And most preventative services are covered at 100%. So if you're enrolled in the high deductible plan and you go for your well woman, your physical, your husband goes for his physical, it wouldn't cost you anything under the high deductible plan towards your deductible. It's covered at 100%. All right? The out-of-pocket differences. On the current Open Access Aetna Select plan, the only out-of-pocket maximum limits are for what the employee, the out-of-pocket maximum only limits how much an employee pays for medical costs. Your dental, your vision, and your prescription costs are not capped. So when you go to the office visit, that goes towards your out-of-pocket maximum. No other services go towards that out-of-pocket maximum on your plan today. Under the high deductible plan, the deductible includes not only medical, but it also you can also pay your dental, your vision, and your prescription costs with your health savings account. All right? Under your current plan, you pay copayments. So when you go to see your doctor, you pay your copayment. There's no additional bill. Under the health savings account with the high deductible plan, you are going to pay the negotiated rate. There are no copayments for office visits, hospital visits, or anything like that under the high deductible plan. There are a few exceptions to prescriptions, but in essence, until that deductible is satisfied, you're paying the Aetna negotiated rate. And then we just talked about prescriptions. On the Aetna Select plan, anytime you go to get your prescription at your local pharmacy, you're paying a copayment. Under the high deductible plan, you're going to pay that negotiated rate. So again, if your prescription is $130, when you go to your local pharmacy, they're going to ask you for $130 until that deductible has been satisfied between your medical and your pharmacy costs. If you do the mail order, for example, and your mail order prescription is $300, the mail order facility is going to ask that you pay that $300 until your deductible has been satisfied. There are not any co-payments under the high deductible plan.
What happens when the deductible is satisfied?
When the deductible has been satisfied, your medical expenses are covered at 80% by Aetna and you pay 20%, and then you have co-pay benefits for your prescriptions. But you have to get through that deductible phase first. Okay, some more differences. As Ron mentioned, when you get your premium deductions, you're going to see that the high deductible health savings account is about 50% less for dependent and family coverage. What a lot of employers offer their employees is a lower premium with the thought that if you take that premium, you can contribute it into your health savings account. So at the end of the day, you may be saving money in your health savings account instead of paying for stuff out of your paycheck that you may or may not ever use under the copay plan. Make sense? Okay. So we talked about different components. So we're going to talk about the high deductible plan. So that's your underlying medical plan. So that's the one with the $1,500 or the $3,000 deductible. The second component is the health savings account. So that's where you put the money into the account on a pre-tax basis, and you can pay for your health care, your dental, and your vision, and your prescription expenses. The third component is member tools and information. In order for you to be an educated consumer, you have to have the ability to go out and see what the negotiated rates are. So under Aetna Navigator, and I'm sure everybody in the room is registered for Aetna Navigator. If you have not, I would highly recommend that you do. Under Aetna Navigator, there is a cost of tool link. If you click on that link, you can see what the cost of some of your services are before you have them done. So just because a provider's in the network doesn't mean everybody gets paid the same. If you go out and look for a colonoscopy, for example, that old colonoscopy, depending on where you go, can be anywhere from $500 to $3,500 for the same colonoscopy. So there are tools out there. There's additional tools for your prescription. So if you are on the latest, greatest medication and you want to say, okay, that's going to cost me $300, but if I take the generic, it's only going to cost me $25, I may talk to my physician about changing my prescription now that I have a $1,500 deductible. Make sense? So there's a lot of useful information out on Aetna Navigator. I would highly recommend you go out there and look at that, especially if you're considering the high deductible plan. Okay? Okay. So we've talked a little bit about this, but let's go through the details. This is your high deductible plan. So as an individual, you have a $1,500 deductible. As a family, which again, if you cover yourself and one other person, you are considered a family, you have a $3,000 deductible. Your preventative care is zero. So your children's immunizations, your well woman, your mammogram, if you're of age for the PSA testings, your physicals, all of those AMA guidelines that you're supposed to get depending on your gender and your age are covered at 100%. Nothing comes out of your deductible, nothing goes towards your deductible, nothing comes out of your HSA. Okay? When you get into the office visits or any of the other services, that's when the deductible applies. So if you go in to see your primary care physician because you have the flu, that's not preventative. They're going to charge you the negotiated rate of that office visit. Once the deductible has been satisfied, Aetna pays 80% and you pay 20%. Likewise, hospital stay. If you go into the hospital and that hospital stay is $3,000, the contracted rate is $3,000. Once your deductible has been satisfied, whatever that portion is, Aetna then pays 80% and you pay 20%, up to your out-of-pocket maximum. Okay, so you don't keep just paying. Likewise, x-rays, urgent care, emergency room. Once you get through the deductible phase, then your prescriptions are 10 for generic, 20 for brand, and 35 for non-formulary. The mail order, you can still get 90-day supply for 2 co-payments instead of 3. But again, the co-payments will apply after you've satisfied your deductible. There are most preventative medications, and there's a list, I think, on your website of preventative medications. If your medication is on that list, say you have high blood pressure or you're a diabetic or something of that nature, you actually get first dollar coverage before your deductible's been satisfied. So if your medication's on the preventative list, regardless if you've met your deductible, when you go into the pharmacy or you do the mail order, you have first dollar coverage just like you do today. Okay? Again, the out-of-pocket maximum is $3,000 for an individual and $6,000 for a family. It is an open access plan, so there are no referrals that are required. So as you do today, you can go see your specialist and you don't have to call your primary care physician. So again, this is talking about the preventative medications, so asthma, diabetes, high cholesterol. Again, when your medication is on this list, you never have to pay that deductible first. You have first dollar coverage. Any other prescription that's not on that list, you meet the deductible, and then you have copays. Okay, so now you've put money into this account. St. Pete College is giving you your free money into the account. How do you get your money out? There's a couple different ways that you can do it. First of all, we work with J.P. Morgan Chase, so you'll receive an orange debit card that looks like this. It is orange so that you don't use it to swipe for your groceries or whatever, your gas or whatever the case may be, because it is only to be used for qualified medical expenses, dental expenses, vision, and prescriptions. You can get up to 2. You will be issued 1, and then you can request a second one. I, myself, keep my own card. My husband doesn't get the card. Okay. Using your HSA. How do you put money into your account? You can do payroll deductions on a pre-tax basis. You can... Yes?
If you get 2 cards, is the deductible amount split among the 2 cards?
No, the question is the deductible. The deductible is the underlying medical plan, has nothing to do with the health savings account. Those are 2 separate components. You have your medical plan that has the deductible here, and then you have your health savings account, and you can choose however you want to use that money to pay for your underlying medical expenses.
So they can have either $3,000 or $6,000 on it, right?
We're going to talk about how you get that. Because right now, if you're a family, the college is going to give you $3,500. So as of day 1, you'll have $3,500 on that debit card. If you go into the hospital...
If you have 2 cards, is the 35 split across?
No, it's under one account.
Okay. All right.
Okay? That's why my husband doesn't get the card. Okay. So you can also put money in After taxes, you can, write a check, say that you're going to have a huge medical expense that's coming up and you want to fund your deductible. You can write a check and put it in your health savings account. You would then have to do the tax, the refund on your taxes because you're not getting the pre-tax benefit. All right. You can also roll over non-HSA accounts or also roll over IRAs. For an individual, the maximum contribution, the government says you can put all this money in tax-free, but you can't just put in as much as you want. As an individual, you can put $3,100 in, and as a family, $6,250. If you're over the age of 55, which nobody in this room is, you are able to make up what we call catch-up contributions, and you can put up to an additional $1,000 per year. If you are enrolled in Medicare, you cannot put any money in a health savings account. Okay? So again, health savings withdrawals, they're tax-free for qualified expenses. If for some reason you pull your money out of your health savings account, that's not a qualified expense. It is taxable plus a 20% penalty, similar to like an IRA or a 401k, and I think you guys have something different here. 403B. So if you do swipe your card and you're audited by the IRS and it's not a qualified expense, you will have tax penalties, and that money is considered taxable income. Allowed even if not eligible to contribute. What this means is now you have this money in your health savings account, and let's say you do it for 2012. 2013, you say, you know what, it's not working for me for whatever reason. I have this money in this account, and choose to enroll back into the Aetna Select plan. You can use the money that's in your health savings account for those co-payments, but you cannot make any more contributions into it unless you're enrolled in a high deductible plan. Okay? So if you have first dollar coverage, you can't make any more contributions, but you can take the money out pre-tax. Does that make sense? Okay. The balance remains available to a spouse upon death, so similar to your life insurance, it defaults to your beneficiary. Okay, so the HSA fund account, the health savings account, is a true bank account. If you go and swipe your HSA debit card and there's no money in there, you're going to get late penalties and overdraft penalties. It is a true bank account, so you can't just go swipe your card and not have any money in there. Likewise, there's an additional checkbook option, but again, there are fees that are associated with it because it is a true bank account. Online bill payment, you can set up online bill payments, and then we're going to talk about the Hsa Auto Debit feature. Using your HSA, the account holder information, again, if you're enrolled in this plan, I highly recommend you register for Aetna Navigator. It's available 24/7. You can actually go out there and view all of your transactions. You can look and see what your balances are year to date. If you want to print out a statement, that's available as well online. If you want a paper statement, you can set that up with JP Morgan, but we typically just do it electronically. And again, the accounts through JP Morgan. Okay, there's a lot of information on this slide. Basically what this is telling you is if you set up what was called your auto debit. Right now, if you have your health savings account card, you can choose to swipe it or not. So the first year that I was enrolled in my health savings account, what I did, I was fortunate enough to be able to do this, is when my daughter went to the pediatrician, I didn't use my debit card. I paid out of pocket for it, and I let my funds accumulate in my health savings account. So after the first year, I had enough money in my account, so if something, God forbid, happened the second year, I had enough money in my health savings account to fund my deductible. You don't have to do that. You can swipe your card if you want to, or this actually makes it easier. If you want to set up for the Hsa Auto Debit, and remember you have to have the funds in your account, what will happen is when the doctor submits a claim, it'll see that you have a health savings account and you've elected this feature. If you have the money in your health savings account, whatever your responsibility is, we will pull out and then pay also what we're responsible for to the provider. If that process happens and you don't have any money in your health savings account, when we send our explanation of benefits to the provider, they will then send you a bill for whatever you owe. Okay? But this will automatically take money out of your health savings account. You don't have that control of swiping when you want to or not to. This, if you set up the auto debit, automatically comes out of your health savings account. So we talked a little bit about Aetna Navigator. It's really the key component to this whole idea is with this high deductible and the health savings account, you need to know what your out-of-pocket expenses are going to be. You need to know what your balances are, and all of that's available through Aetna Navigator. You can also go out there and see what an office visit is going to be. I will tell you, my pediatrician, just because it's the same pediatrician doesn't mean he bills for the same services all the time. When I take my daughter at 11 o'clock in the morning, his contracted rate is $52.53. If I take her after 5 o'clock, that's $83.52. If I take her on a Saturday, it's $120, and on Sunday, it's $120 plus a $50 holiday fee. So when my daughter's not feeling well, guess when she goes to the doctor? Exactly. So the idea is under this plan, if you're just paying your $20 or $30 copayment, you don't know because you don't see those costs, and you're going maybe at 5 o'clock or on a Saturday, and then the college is paying those expenses. So the idea is for you to become better educated, even if you're on just the copay plan, is to come out here and look at these tools so you can see what the true cost of healthcare really is. Okay. All right. Using your HSA debit card, you have to activate the card in order for it to work. You can be reimbursed for all or part of the account holder's qualified expenses. You can also use it at the point of sale location. So when I go to the pharmacy, I give them my debit card, and then they swipe it right out of my account. There's no restrictions on a debit card by merchant code. So the onus is on you that if you go to Walmart and you swipe your debit card, it better be for a qualified expense, or you will have tax penalties and withdrawal penalties. Okay. Again, it is a true bank account, so there may be some additional fees that are associated by going for an ATM withdrawal or something like that. Daily limits are $3,000 and purchasing limits are $5,000. So again, it is a true savings account. The money has to be in there in order for you to take it out. In addition to that, there is a service fee associated with the account. So if you open up a health savings account, $3.90 will come out of your health savings account on a monthly basis. Okay, so there is a service fee that's associated. If you decide that you want to enroll in the high deductible plan, you're not required to set up a health savings account. You're not required to set it up with JP Morgan. You can go to your own bank and do that if you want to, but then you lose the trackability feature under Aetna Navigator. So again, whether you're on the high deductible plan, the Open Access Aetna Select, or the Choice 2 plan, there's a lot of good information out on Aetna Navigator. You can look at your claims, your balances, your eligibility information, print off temporary ID cards. If you have a question about a claim, you can click on the claim and send it to member services and then respond back within 24 hours. Hospital comparison tool, you can compare the hospitals and see what the mortality rate is for your certain procedure or what the outcomes are. That type of information is out there as well. Price of drug is huge. If you do nothing else, I would at least go and look at the cost of care tools. So when you log in, when you go to Aetna.com, for those of you that have not registered, on the left-hand side, you create your own username and password. It's very easy to do. You only need to know 5 things about yourself: your name, your first name, your last name, your zip code, your date of birth, and one other thing. But it should be very simple to do. Once you've registered, you can access it anytime, anywhere. It is a secured registration, so it's not anybody that's going to access your information. We've added a new feature called Ask Ann. She's a virtual assistant, so if you're lost or you're not sure what to do, you can type in your question and she will actually talk back to you and give you the answer that you're looking for. The other thing I would point out is on easy access information. Ron showed me the pointer. Right up here, there's a site map. When you go across this toolbar, it drops all these different links down, and it's hard to follow. But if you click on the site map right here, it'll show you every hyperlink that's within Aetna Navigator, so it's on one page so you can kind of figure out where you need to go. Okay? Once you register for Aetna Navigator and you enroll in the health savings account, it'll come up on your home page. You can actually look at the details of your health savings account. Again, you can look at your transactions, what your balance is, what your deposits are. If you want to print out a statement, you could do that as well. This is just a summary of the transaction, so it shows you what your current balance is, what you have available. Once you receive it, actually there's an investment account balance. Once you receive accumulate a certain threshold, I think it's $3,500, $2,000. You can actually diversify the funds, and if you want to put something in a more aggressive fund, you can do that with the bank as well. So that's an option also. For everybody that has an iPhone or a smartphone, iPhone, BlackBerry, and also the Droids were just added. There's a mobile app that you can download, and what's really nice about it is the cost of care tools, your ID card, so you don't have to carry that plastic ID card in your wallet anymore. You can just show it to show the provider on your phone. So it's a really, really cool if you have a smartphone. For those of you that may have any questions in the middle of the night, or you have a condition, you're not sure what to do, you actually have access to an RN registered nurse 24/7. It's an 800 number, and they have access to all of your information. I've used it myself 2 or 3 o'clock in the morning with a sick daughter, and they can kind of walk you through what steps you should do until you can call your doctor the next morning, or give you some guidance on what you should be doing with whatever question you have. Is this mine or yours? Mine? Okay. All right, so the countdown to 2012. So we're doing the information sessions from October 3rd through the 18th. Your open enrollment starts on October 24th and goes through November 4th. The new plan starts on January 1st, and the new payroll premium deductions start on your first payroll, which is January 13th. So, a lot of information, a lot of alphabet soup. Are there any questions?
You can choose how much you want to contribute, because right now, we obviously pay a certain amount.
Mm-hmm.
So we just decide how much we want to put in, as long as it's up to 31. It can't be more than 3,100 for an individual.
Yeah, the question is contributions. You can contribute as much or as little as you want. If you don't want to make any contributions and you just want to take the money that St. Pete College has given you, that's fine. If you do decide to do the payroll deductions, it'll be pre-tax on whatever amount you decide for the 12-month period.
And that reduces your tax liability.
Correct. It does reduce your taxable income.
And then depending on how it goes, can you adjust it so that,
No, we're going to...
or is it like a one-time thing and you have to wait a year?
Yeah, we're going to handle it the same way we handle the FSAs. So if you currently do flexible spending accounts, okay, where you set aside a certain amount of money, and we deduct up to the amounts so we can accumulate that certain amount of money. So it's the same way we're going to handle FSAs, we're going to handle the HSA.
So the answer for everyone that may not have heard that is whatever you elect, it'll be your election for the whole year.
And then if you have to modify it, then you have to do it the following year.
Correct.
Any changes would then take effect for 2013. Yes, ma'am.
If you have a family member that's covered under other insurance, can you use the health savings account to make purchases for their medical stuff too?
Yes.
Okay. What's the interest rate?
0.14?
I think it's 0.14, I believe.
I think. Yes.
The 4% in January and in July, that applies whether you're in the HSA or just the select.
The question was, is the premium increases that go into effect for January and then again in July are for all plans?
No, the premium increases are just for the open access, the regular plan, or the points of service.
Okay.
The points of service. Okay. Those two plans. The HSA plan will have its own defined premiums for this year. Again, it's a pilot, so the premiums will be much lower than those other plans.
Okay, so for those of you that may not have heard, the premium increases apply to your current existing plans. They do not apply to the health savings account. Or, I'm sorry, the high deductible plan. Yes?
When I had insurance before, it was for the maximum out of pocket. Like, even if I was with someone else in the family on the plan, if I paid like the maximum out of pocket for mine, then they would cover my health
Under the high deductible plan, you're considered a family unit. There's no embedded.
Not split up at all?
I thought it was, let me go back and
He'll confirm that.
I'll confirm that. 'Cause I'm thinking it's split.
Okay, because we typically, okay. Yes?
I currently have an FSA account. Can I continue FSA and have an HSA?
The only way that you can continue your FSA is the government doesn't allow you to double dip. So you would have to use your health savings account for all of your medical expenses until your deductible has been satisfied. So your FSA is what we call a limited FSA. Are you offering that? Mm-hmm. And that was only for your dental and your vision.
So dental and vision only for the FSA.
Correct.
And would acupuncture or compounding pharmacy be considered acceptable within the HSA?
If they're currently being covered by the FSA, yes.
Okay.
There's different rules. You have to have prescriptions and things like that. But if they're currently being covered under the section of the IRS code for the FSA, they should be covered under the HSA.
Thank you.
Yes, ma'am.
For child care, you still have to have a FSA?
Yes.
Yeah, this is just medical expenses and dental, vision, and prescriptions.
Repeat the question, please.
I'm sorry. Dependent care is still under the FSA.
You mentioned that this was a pilot. Does this mean that if it doesn't work too great, it'll go away, or?
Well,
I don't know. I mean, I know
our plan is for it to work. And so
right. I
it's-
mean, I know, but a pilot, you kind
Right,
of.
and so
I'm not
what
sure
we'll
that-
do, we'll reevaluate it at the end of 2012 to determine whether or not employees are benefiting from this program or not.
So
We offer it again.
for those back there, it is a pilot program. So the medical portion, the high deductible plan, is the pilot program. Remember, your health savings account doesn't go away. So if in 2013 the college says, you know what, we're not going to offer a high deductible plan, any money you have left in that health savings account you can still use for your medical expenses.
And that's, I guess, one of the benefits, because you keep that money if you don't use it.
It is a very big benefit. It's very different than
Right.
the other
Otherwise,
accounts.
If you use it or not, you're paying for it.
Correct. Yes.
With the $3.90 fee a month, sometimes when you have other accounts, if you have a direct deposit, you can avoid that fee, like Chase, for example, if you do 5 or something. Is there a way that you can structure it so that you can avoid that $3.90?
No, it's associated with the health savings account for the administration of it. I'm sorry, the $3.90 that comes out of your health savings account, there's no option, but you do pay that on a monthly. There's no way to waive that. Yes.
I want to follow up on the premium increase again. If I understand correctly, you can get the Aetna Select with the HSA or without the HSA. Is that right?
There are 2 plans that are being offered. The Aetna Select with the high deductible is the high deductible plan with the HSA. Then you have your open access Aetna Select that you currently have that have some copay changes. So they're 2 different. They're named the same, but the benefits are very different.
Right. Okay. Then my question on the 4%, it applies to just the.
The 4% applies to the copay plans that you currently have today. It does not apply to the HSA, or the high deductible plan, I should say. Yes?
So what you're saying is that if you went with the high deductible, you're not getting money taken out every month toward the premium?
No, what I'm saying is the HSA or the high deductible plan has a lower premium, and on the other 2 plans that are being offered, the Aetna Select and the Choice 2, your premium is going to increase in January and then again in July. But they both have premiums. It's just the high deductible plan will be a much lower premium than the ones that you're currently paying. That will be subject to increases in 2012.
Okay, the other question is then, if there's the $3.90 charge per month, but yet there's an interest of 0.14?
Mm-hmm. That's a going rate as far as banks. If you look at the savings accounts, that's pretty common right now, unfortunately. Any other questions? Yes, ma'am.
I'm sorry, I'm just trying to understand the process, because you said that, I guess, the total cost if you're an individual is around $3,000. So hypothetically, I know you have to meet your deductible. You explained that. Something catastrophic happens and you're hospitalized. What happens then?
The question is what, as an employee, you have your deductible of $3,000, and then you have your out-of-pocket expense, the coinsurance, which was, no, for an individual. Oh, for an individual, the deductible is $1,500, and then the coinsurance phase is $1,500.
Right.
That's the most that you're going to pay in a calendar year for your medical expenses.
Is $3,000?
Correct.
And then so if something, again, unexpected, catastrophic happens,
You have 100% coverage
Okay.
after that out-of-pocket phase has been met.
Okay.
Any other questions? Yes, ma'am.
Again, I'd like to thank everyone for coming out this afternoon. Please look to your blue and white for additional details concerning the new high-deductible health plan that we're piloting, as well as the fact that we will be having sessions throughout other campuses. We'll be having on-campus coaches during the course of the 2012 calendar year to help you get through this maze of what we're calling a high-deductible health plan with an HSA. Should you need any additional information, feel free to give me a call or call anyone in the benefits office. Again, I'd like to thank you for coming out and sharing in this information with us this afternoon.